The S&P 500 just gained 1.15%, and the Nasdaq gained exactly zero. Same day, same market. That is not noise. That is a signal. When the two most watched U.S. equity indices decouple on a single session, it means capital is moving with intention, not just broadly flowing into risk. The VIX dropped 8% to 16.3 on top of that. So the question isn't whether today was a good day for markets. The question is, who actually bought? What did they buy? And what does that tell you about where the next move originates? Let's start with the most important number most people ignored today: zero. The Nasdaq's flat close, while the S&P 500 climbed 1.15%, is not a contradiction. It's a rotation signal, and it's one of the cleaner ones you'll see in a single session. The S&P 500 is a market cap-weighted index, but its sector composition is meaningfully different from the Nasdaq's. The Nasdaq is approximately 55% concentrated in information technology and communication services. The S&P 500, while still tech-heavy, carries substantially larger weights in financials, industrials, healthcare, and energy. When the S&P rallies and the Nasdaq doesn't, the math tells you those non-tech sectors absorbed significant buying pressure today. As of June 15, 2026, this pattern is consistent with what institutional desks call a defensive growth rotation. Money moving away from high multiple rate-sensitive tech names and into sectors with more predictable cash flows and lower duration risk. Financials in particular tend to outperform in this setup because they benefit from the same macro environment that puts pressure on long-duration tech valuations, a yield curve that has any positive slope at all. Here's the actionable read. If you're trying to understand where institutional money is flowing, stop watching the headline index and start watching the S&P equal weight index relative to the cap-weighted version. When equal weight outperforms, breadth is expanding. Broader participation means more durable rallies. Narrow participation, a handful of megacaps carrying the index, fragility. Today's divergence suggests real breadth underneath, which is structurally more bullish than a Nasdaq-led rip would be. The VIX closed at 16.3 today, down 8%. Most headlines will treat that as a footnote. It isn't. The VIX, the CBOE Volatility Index, measures the 30-day implied volatility priced into S&P 500 options. It is, in the most literal sense, the market's collective bet on how much turbulence is coming. An 8% single-day drop is not trivial. That's options dealers pricing out a meaningful chunk of near-term uncertainty in one session. Here's the framework that actually matters. The VIX has three behaviorally distinct zones. Above 25, you're in fear territory, sei. Institutions are hedging aggressively, risk models are flashing yellow, and many systematic strategies are reducing exposure. Between 18 and 25 is the transition zone. The market is processing something. Uncertainty is elevated, but not panicked. Below 18 is the complacency corridor. At 16.3, we are firmly in that corridor. Now, complacency gets a bad reputation because people conflate it with danger. Low VIX environments are actually statistically correlated with positive forward returns over 3 to 6 month windows. The VIX being low doesn't mean a crash is coming. It means the market is not currently pricing one. Those are very different statements. What low VIX does do is compress option premiums, which changes the calculus for anyone using options as a hedge or as a directional tool. The more important signal embedded in today's VIX move, it suggests that whatever macro anxiety was priced into markets earlier this month, whether that was rate path uncertainty, geopolitical noise, or earnings risk, that anxiety is being unwound. Institutionally, that's a green light for risk-on positioning, not a warning sign. Keep in mind, this is not financial advice. It's a framework for interpreting what the options market is signaling. which is something very different from a prediction. The rally happened. The VIX compressed. Now, the question every serious investor should be asking is, what validates or invalidates this move in the next 5 trading sessions? There are 3 things worth tracking closely, and none of them are the ones CNBC will spend airtime on. First, watch the high-yield credit spread, specifically the ICE BOFE U.S. High Yield Index option-adjusted spread. When equity markets rally but credit spreads don't tighten, or worse, widen, it tells you the bond market doesn't believe the equity story. Credit leads equities at turning points more often than the reverse. A genuine risk-on move should see high-yield spreads compressing alongside the equity rally. We treat today's move with skepticism. Second, watch the equal weight versus cap weight ratio we mentioned earlier. If the S&P 500 continues rallying over the next week but equal weight underperforms, the rally is increasingly dependent on a smaller number of large positions. That's a structural fragility that historically precedes mean reversion. Third, and this one is more tactical, watch the put-call ratio on the S&P 500 over the next 48 hours. A falling VIX alongside a falling put-call ratio means traders are actively removing hedges. That's confidence. A falling VIX alongside a rising put-call ratio means someone is quietly buying protection even as the market celebrates. That's a tell. The larger context for June 2026. Markets have spent the first half of this year repricing a lot of macro variables. Today's session looks like one data point in a potential consolidation of that repricing. Not a euphoric breakout, not a dead cat bounce. The weight of evidence currently leans constructive, but constructive is not certain, and anyone who tells you otherwise is selling something. Your edge is watching the confirmation signals, not the headline. So here's where we land. The S&P gained 1.15%, the Nasdaq was flat, and the VIX just dropped 8%. That combination is a rotation signal, not a random day. Credit confirmation and the put-call ratio will tell you in the next 48 hours whether today's move has institutional conviction behind it or not. Now the follow-up question worth sitting with.